Welcome to The Explainer. Today we are diving into a really fascinating, high-risk, high-reward financial tool. It's the kind of thing that makes those billion-dollar skyscrapers you see even possible. We're talking about mezzanine debt. You could call it the secret sauce that bridges the gap when a regular old bank loan just isn't going to cut it.
All right, so here's how we're going to break this down. First, we need to understand why this stuff even exists, so we'll look at the real estate funding gap. Then, we'll get into the nitty-gritty. What exactly is mezzanine debt? From there, we'll unpack its most interesting feature, how it's a loan against ownership. Then, we'll look at the trade-offs, the pros and cons for both sides. And finally, we'll see where this high-stakes tool really fits into the big picture. Let's get into it.
So to kick things off, let's just ask a really simple question about a very big problem. I mean, when you see a brand new skyscraper shooting up into the skyline, have you ever just stopped and wondered, how in the world does a developer pay for that? We're talking hundreds of millions, sometimes billions of dollars. Where does that money come from?
Well, the answer to that question, it really starts with a huge problem that every single large-scale developer runs into. It's called the funding gap. Because you see, even for the biggest names in the game, a traditional mortgage just isn't going to be enough.
Okay, so here's the deal. A developer, right? They go to a bank to get their main loan. In the industry, they call this the senior loan. But here's the catch. The bank will only cover, say, 60 to 75% of the total project cost. That leaves a massive, gaping hole in their funding. They still need to find millions, maybe tens of millions of dollars, just to get the project off the ground. So what do? How do you fill that gap? You could sell off a big chunk of your ownership to investors, but what if you don't want to? Well, this is exactly where mezzanine debt makes its entrance. It's a really clever, kind of hybrid solution. Okay, so what is this stuff? Mezzanine debt it's a really interesting beast. It's not just a loan, and it's not quite an ownership stick or equity. It's this hybrid, right in the middle, that blends features of both debt and equity. And it sits in a very, very specific spot in the financial structure of a deal.
In this chart, this shows it perfectly. This is what's called the capital stack. Think of it like a totem pole of who gets paid first. At the very top, you've got the senior debt. That's the big bank loan. It's the safest, so it has the lowest return. At the very bottom, you have the owner's own money, the common equity. That's the riskiest position. And where's mezzanine debt? It's squished right there in the middle. It gets paid after the bank, but before the owners.
So what's the result of adding this layer? Well, now the developer can finance up to 80, maybe even 90% of the entire project's cost. This is a huge deal. It means they have to put in way less of their own cash, which frees them up to do bigger projects or maybe even juggle multiple deals at the same time. It's all about leverage. Okay, but here's where things get really interesting. What truly sets mezzanine debt apart, and frankly, what makes it so powerful, is how the loan is secured. Because it's not secured by the building itself. And that one little difference, it changes everything. Yeah, let that sink in for a second. With a normal mortgage, the bank puts a lien on the property. With mezzanine debt, the lender's collateral isn't the physical bricks and mortar. No, their collateral is the ownership of the company, the LLC or partnership that owns the building. They are literally making a loan against the shares of the company, not the property.
And why does this matter so much? Because this structure allows for an incredibly fast foreclosure process if the borrower defaults. The lender doesn't have to go through the courts for a typical, slow real estate foreclosure. Instead, they just follow a commercial code process to seize the ownership shares. The whole thing can be over in 30 to 90 days. And just like that, boom, the lender now owns the company that owns the skyscraper.
Now you can probably guess that this kind of power for the lender doesn't come for free. And that brings us right to the central trade-off of mezzanine debt. It's a high-stakes game of risk versus reward for everybody at the table.
First up, the cost. It's steep. You know that senior bank loan we talked about? That might have an interest rate of, say, 5, 6, 7%. But for mezzanine debt, you're looking at rates more in the range of 9 to 14%, and sometimes even higher than that. That extra interest is the price the borrower pays for that flexibility, and it's the reward the lender gets for taking on more risk.
So why on earth would a borrower agree to pay that much? Well, for them, it's all about leverage. It lets them do a much bigger deal with less of their own cash, which can supercharge their potential returns. And, just as important, they get to keep control. They don't have to bring in new equity partners and give up a slice of the pie.
And what about the lender? What's in it for them?
Well, obviously that high interest rate means a much higher return. That's the big one. But it's also about that powerful foreclosure right we just talked about, the ability to take control of the entire asset quickly and cleanly if things go south. That is a huge advantage, and it's what makes the risk worth taking.
But make no mistake, that risk for the lender is very, very real. Remember their spot in the capital stack? They are second in line. So, if the property's value takes a nosedive and falls below what's owed to the senior bank, the bank still gets paid first. The mezzanine lender? They could be completely wiped out. Their entire investment could just vanish.
Okay, so let's zoom out a bit. Let's put all these pieces together and really understand where this high-stakes financial tool fits in the grand scheme of things.
A lot of people get mezzanine debt confused with something similar called preferred equity, but there's a key difference you need to know. Mezzanine is legally debt. That's what gives the lender those powerful foreclosure rights. Preferred equity, on the other hand, is, well, it's equity. It's an ownership stake. That means it has fewer legal protections and sits even lower, in an even riskier spot on that capital stack.
So, why does any of this matter? Here's the bottom line. This complex, kind of shadowy financial tool, it plays an absolutely critical role. It's the financial engineering happening behind the scenes that provides the fuel, the high leverage capital that allows developers to build those huge, ambitious, landmark buildings that literally shape the skylines of our cities.
When you boil it all down, mezzanine debt really is a fundamental question about risk and reward. It's a financial high-wire act with huge potential payoffs and catastrophic risks for both the borrower and the lender. And it leaves you with a big question, doesn't it? In this constant race to build bigger and bolder, is the potential reward really worth the very real risk of losing it all?